Welcome back. In this video I want to talk about double entry accounting. What does that mean? Double entry accounting. Well, in the last video we looked at the T account. Okay? We looked at one tool and one rule. Tool is a T account. Account name. It's like taking out a piece of scratch paper. You're a carpenter and you're getting ready to build a house. You're trying to figure out how to you're doing some measurements, and so you take out a piece of scratch paper and you write down the measurements, size of 2x4s and things like that. So think of a T account as a piece of scratch paper for accounting. It's a tool that we use for understanding how a transaction impacts an account. And then the rule was one tool, one rule. And the rule was under the T account that what? Debits are on the left, credits are on the right. So having our tool, T account, and our rule, debits are on the left, credits are on the right of the T account, right? Debit, credit. Double entry accounting. What does double entry accounting mean? Double entry accounting says that the total of the debits will equal the total of the credits. Accounting is about balance. So double entry accounting says that the total of the debits must equal the total of the credits for every transaction. If the total debits is $125, then the total credits must be $125, not to the same account. It also means that we will always be posting to at least two accounts. So number one, total debits equals total credits. That's in dollar amounts. And the second thing is that we will always be posting to at least two accounts. So we can always put at least two T accounts. So if we sell sneakers for cash, we have cash, and we have we haven't gone through the rules of debits and credits as they apply to different kinds of accounts, but just for sake of illustration, let's put cash and sneaker revenue. That's SN period, abbreviating sneaker revenue. We know that double entry accounting says that the total of debits will always equal the total of credits. And we've sold $100 worth of sneakers for cash. So without going into the rules of debits and credits, if I put $100 right here, double entry accounting tells me that I must have $100 over there. Because notice that debits, total of the debits, $100, must equal the total of the credits, $100. It's a wonderful safeguard, double entry accounting. You can put together transactions and post transactions and record journal entries by just understanding that the debits have to equal the credits for any journal entry. If you write a journal entry and your debits don't equal credits, you should know that something is wrong. Double entry accounting is what assures us that as we begin to move forward and record transactions, it gives us a safeguard along the way. It doesn't mean that we're always posting and recording to the right accounts. It just gives us one safeguard along the way to say, I know that if the total of my debits does not equal the total of my credits, then I know with certainty something's not right. It doesn't guarantee that I'm putting it in the right account. It just means that I'm recording the right amounts, and I'm recording the right amounts in a fashion that is in conformity with generally accepted accounting principles. So remember this, generally accepted accounting principles. Double entry accounting is that what? The total of the debits must equal the total of the credits. And we will always be posting to at least two accounts. So if you're a person that likes certainty, you like check and balances, you like things to be in balance and to be right, double entry accounting is going to become your friend. You will like double entry accounting because it requires that the total of the debits or the total for the credits. Now it's going to turn out that whether we're talking about assets, remember our equation, assets equals liabilities plus owner's equity, and owner's equity is influenced by what? Revenue minus expense accounts, right? Each one of these accounts has different kinds of balances, debits versus credits. So if it's an asset account, I think I'll do a separate video on this, but just to introduce it, an asset account, if you want to increase an asset account, the question is, do you debit it or do you credit it? If you want to increase a liability account, do you debit it or do you credit it? If you want to increase an owner's equity account, do you debit it? Do you credit it? If you want to increase a revenue account, do you debit it? Do you credit it? If you want to increase an expense account, excuse me, do you debit it or do you credit it? I'm going to do another video on this, but those are the questions. Those are kind of the rules of posting for debits and credits in the accounting equation, which I'll do another video. See you in the next video.